In this ultimate video course, you will learn everything you need to know about candlestick patterns for trading stocks, Forex, crypto, or any other financial market. By watching the full course, you will not only be able to trade candlestick patterns like a pro, but you will also gain the edge to profit in both bull and bear markets. So hello guys, and welcome to this candlestick pattern trading course. This right here is going to be a pretty long video, so make sure to grab a pen and paper, perhaps grab a coffee as well, and without further ado, let's get started here. And let's begin here by super quickly taking a look at what you can expect to learn from this course. We will start this course off by taking a look at both how to read but also how to understand candlesticks and candlestick patterns. We will take a look at the very basics, but we will also look at concepts like candlestick strength, candlestick momentum, we will take a look at wicks, and much more. After chapter 1, when we have a good understanding of the basics, it's time for chapter 2. And in this chapter, we will take a look at candlestick pattern classifications. In order to master candlestick patterns, it's of course very important to understand, what type of candlestick patterns you are trading, what types do you want to focus on, what types do you want to avoid, and so on and so on. So chapter 2 here is very important, and this will be a quick chapter, because every single candlestick pattern has 3 different categories. Every pattern has a complexity level, every pattern has a direction, and a type. And as I said, don't worry if this sounds a little bit complicated right now, it will be clear very, very soon. In chapter 3, we're going to take a look at the best reversal candlestick patterns. And we will not only look at the patterns, but we will also take a look at trading strategies for every single candlestick pattern. And reversal candlestick patterns are one of the most effective candlestick types. And if you learn all of these patterns, and even more importantly, if you also learn about the trading strategies for these patterns, I'm sure you will become a much better trader. And for example, if you take a look at this image right here in the upper right corner, this right here is an example of a reversal candlestick pattern, and we will take a look at that exact pattern and how to trade it later on in this video. And so much more. But now, in chapter 4, it's time to take a look at the best continuation candlestick patterns. And we will of course also take a look at trading strategies for every single pattern. Understanding continuation patterns is something you pretty much can't do without as a trader. And in chapter 4, I will talk about multiple continuation patterns, including one of my personal favorite patterns of all time. So make sure to stay tuned for that. And last but definitely not least, we're gonna take a look at the doji and the spinning top candles. And these are a specific family of candlestick patterns that is super important to understand as a trader. These are patterns that happens all the time in the market, and they can provide significant signals, both warning signs but also entry signals that we as traders need to be able to utilize. But alright guys, let's get started here with chapter 1. Alright, so before we start looking at all the candlestick patterns and everything you need to know about the actual candlesticks, we of course have to start here with the basics, and that is of course, how do we read candlesticks and how do we read candlestick charts? Well, first things first, we have 2 different types of candles. We have a red candle, which is also called a bearish candle, and we have a green candle, which is also called a bullish candle. Sometimes if you see a black and white chart, it is the green candle that is white and the black candle is red. And the difference between these candles is that during the red candle, the price goes down, and during the green candle, the price goes up. And each candle can represent different time periods. So one candlestick can be, for example, 1 day, but one candlestick can also represent, for example, 1 hour. I'm sorry for my ugly writing here, but I hope you can see. And one candle can, for example, represent 1 minute. And these different time periods right here is what we call time frames. And when you are looking at the chart in, for example, TradingView, you can choose what type of time frame you want to trade. So for example, if you choose a daily time frame, then every candlestick on the chart will represent 1 day. But if you choose, for example, 1 minute time frame, then every candlestick you see on the chart will represent 1 minute, and so on and so on. But to make this example simple, we can think about every candlestick right here as representing 1 day. And now, and this is very important, every single candlestick has 4 different points. We have a high, we have a open, we have a close, and we have a low. And for the red candle, remember that during this candle, the price falls. So the candle opens right here. Or in other words, if this is a daily candle, the open price is the price level at the start of the day. The high right here is the highest point the price reached during the day. So perhaps the price opened right here, it went up all the way up here to the high. Then the next point here is the low. That is the lowest point the price reached during the day. So as I said, the price might start right here, it went up to the high, but then during the day, the price went down all the way down here to the lowest point. I hope you can see, all the way down to the lowest point. And then before the end of the day, the price went up all the way here to the close. So during that red candle, the price might have moved something like this, right? And when you understand the bearish candlestick, you will also very easily understand the bullish candlestick. This is basically the exact same thing, but the opposite. So in this case, the price opens or starts all the way down here. During the candle, the price went down here to a lowest point all the way down here. And during the day, the price went up all the way up here to a highest point all the way up here, and before the day ended, the price came down here to the closing price. So this right here is basically how you read the candlesticks. But we have a few important concepts we also need to learn about. The first concept is what we call a wick or a shadow. And you can see that we have these both at the top, or we can have them at the top and the bottom. And the wicks and the shadows are simply these small lines right here that are either above or below the candles. And these small points show us the highest and lowest point of the period, or in other words, the time frame. Last but not least, we have something called the body. This is also sometimes called the real body, but in very simple terms, the body is the wide part here of the candles. And remember, the wide parts of the candle determine the closing and the opening price. And one last thing here I just want to mention is that these names, open, high, low, and close, these points are for short called OHLC. So if you ever stumble upon something called OHLC, you know that this means open, high, low, close. And this is based on the candlesticks. Alright then, so now when we have a basic understanding of how to read candlesticks, now we are ready to talk about something called bullish and bearish strength. And now I want you all to focus on this image right here. And the first thing I want you guys to notice about these candles is that for all of these candles, the highest points are at the exact same level, right? And we can also notice here that for all of these candles, the lowest points, so the low here, are also at the exact same level. So the only difference between all of these candles is the body of the candles, right? And the bodies of the candles are very, very important because they are one of the most important factors. They're actually one of two factors that determines how bullish or bearish a candlestick is. So for example, if we take a look at the candlestick all the way to the left here, we can see that the candle opens all the way down here, and during the candle it pushed up to a highest point all the way up here. So this basically represents a very strong movement here towards the upside. But if you take a look at the candle all the way to the right here, you can see that the opposite is true. It opened all the way up here, and during the candle, it pushed down all the way down here. But now, I want to talk about a very important thing here, and that is that even if we see a candlestick that looks, for example, like this candle right here, this doesn't mean that the candle during the day fell in a straight line like this. It could have moved something like this. Remember, it might have opened all the way up here, and then during the candle, it might have moved, you know, something like this, something like a trend here towards the downside. The only thing we know for certain about this candle is that it opened here, it closed here. And since we have no wicks, so we have no wicks like this and like this, we also know that the highest point during the day was this point, and the lowest point during the day was this point. But now, if you take a look at, for example, this candlestick right here instead, we can still see that the highest point of the candle and the lowest point of the candle is at the exact same level. But this candle right here tells us a very different story about the price. Because during this candle, it opened right here, and then we fell all the way down here, right? But before the candle closed, the bulls managed to take control and actually reverse the price all the way up to this point. So while this candle right here is very bearish and shows lots of bearish strength, this candle is actually much more bullish. And this candle is actually almost something we call a hammer. And that's actually a bullish reversal candle. And we will talk more about the hammer, and we will talk about a hammer trading strategy later on in this video. But for now, all you need to know here is that this candle is much more bullish. But now let's actually focus on this candle right here. You can see in this case, we have a very, very small body of the candle, but at the same time, we have very long wicks. You can see we have a long upper wick and we have a long lower wick. So during this candle, perhaps the price moved something like this. It started here. During the candle, we went all the way up here. During the candle, we also fell all the way down here, right? But before the candlestick close, we pretty much close here at the exact same place where the candlestick started. So these kind of candles, when we have very small bodies and very long wicks, these candles are actually neutral. So they don't really show any bullish or any bearish strength. What they basically show us is something called indecision, or in other words, that neither the bulls or the bears are in control of the market. And this specific candle is actually something we call a doji candle, and I will talk more about doji candles and why they are so important later on in this course. Alright, so now it's time to actually switch the attention here and take a look at something called candlestick wick analysis. And as you can see here on the screen, we have two different candles, but they are actually very similar if we look closely. We can see that the high point here for all the candles are at the exact same level. We can also see that the candle opened at the exact same price, and the candles also closed at the exact same price. So the only difference between these two candles is that for the candle to the left here, we had a low point all the way down here, but for the candlestick to the right here, we had a low point down here. And this difference here between the low points are actually more important than you might think. So let's actually visualize these two candles. So for the candle to the right, we can imagine that the price opened right here, but then during the candle, we can see that the price reached a point all the way down here, and then it quickly pushed up all the way up to the highest point, and before the candle closed, we closed all the way down here. But if you take a look at the candle to the right here, we can see that it has a similar start, but during the candle, it went down to this point, it went up to this point, and then it went down. So here for the candlestick to the right, you can see that the move we saw from the low to the high was much longer compared to the move we saw here to the right. You can see this move was only this far, while the move to the left was much stronger. And that means that this candle is actually more bullish compared to this candle, because we need more bullish strength to push the price from all the way down here up to this point compared to the strength we need to push the price from this point to this point. And when you look at the chart, especially as a beginner, you might feel like these two candles are basically the same thing, But it is these sort of small differences, like the candlestick wick right here, that can really make a difference. And especially, let's say that we, for example, have a support area right here, then these type of candles, when the price wicks below and then quickly pushes above the support, this becomes even more important, because this tells us that we actually found buying pressure coming in at the support level, which is yet another bullish sign. And now let's really quickly here take a look at another example. This one is pretty similar. As you can see, we have the lowest point for both of these candles are at the exact same level. We have the open here at the exact same level, and we also have the close at the same level. Once again, the difference between these two candles is that to the right, we had a very long upper wick, right, or upper shadow, and to the right here, we have a very short upper shadow. So now, as an exercise, I want you guys to drop a comment down below and tell me which of these candles are the most bearish. Feel free to pause the video right now if you want to. Well, the answer here is that the candle to the left is more bearish, because during this candle, the price opened here. During the candle, we pushed all the way up to this point, but the bears took full control here and managed to push the price all the way down to this point. While in the other candle, we had a much sort of weaker movement. This is still a bearish movement, but the price moved something like this, right? And you can see that this movement right here is much more bearish compared to this movement right here. And once again, this becomes even more important if we, for example, have a resistance area right here, because in this case, the candle to the left confirms that the resistance is holding. All right, so now the time has come to take a look at one of the most important concepts when it comes to candlesticks and candlestick patterns, and that is candlestick momentum analysis. And first of all, we need to, of course, understand here, what is momentum? What does momentum mean when we talk about candlestick patterns? Well, in simple terms, we can think about momentum as the speed or velocity of price movement. Or in other words, we're talking about how sort of fast is the price moving compared to the previous candles. So in this example, you can see that the very first candle is a red one, and it is a pretty strong red candle. The next candle here is, getting a little bit weaker, and we can see that because the length of the real body of the candle is getting a bit smaller. If we take a look at the third candle right here, we can see that the real body is even smaller here, and we also have some pretty long upper and lower wicks. And you know from earlier in this course that when we have small real bodies and long wicks here, this basically signals uncertainty, or in other words, that neither the bulls or the bears are in control. And if we take a look at this last candle right here, you can see that the real body is pretty much non-existent. We have a very small real body. The candlestick opens and closes at the same level. So this right here is a doji candle. So for this downtrend right here, we can see that the momentum is decreasing. And if you want a simple tip to determine the momentum of a candle, I recommend to focus here on the real bodies. The longer the real body, the stronger the momentum in general. You need to also consider the wicks here, it's also important, but as a rule of thumb, the longer real body we have, the stronger the momentum. So by looking at the real bodies here, we can see that the momentum is decreasing. And now I want you guys to learn a very important concept, and that is something called momentum candle. And what is a momentum candle? Well, different traders have some different definitions when it comes to momentum candles, but I like to define momentum candles as a candlestick that is at least 2 times larger compared to the previous candles. So for example, if we look at these 3 previous candles right here, we can see that the real body of the green candle right here is more than twice the size of the previous candles. So that's why I consider this right here as a momentum candle. And momentum candles are very important because they can provide strong signals when we trade. And I will talk more about momentum candles later on in this video. But for now, all you need to know is that momentum can be determined by the real bodies of the candle, and momentum candles in general can be defined as a candlestick that is at least twice the size of the previous candle. But preferably, we want to see a candle that is, maybe 3 times as large, or even, 5 times, sometimes it can be even 5 times as large as the previous candles. And then we are talking about a very strong momentum candle. All right, so at this point in the course, you already have a, pretty good understanding of how to read candlesticks, about, wick analysis, about momentum and strength. So now we are very soon ready to start taking a look at our candlestick patterns and also our candlestick pattern trading strategies. But real quick, before we look at that, we need to learn about the classification of candlestick patterns. So first of all candlestick patterns has 3 different classifications. The first classification is called complexity. And a candlestick pattern can be either simple or complex. And a simple candlestick pattern is a candlestick pattern that consists of only one candle. So for example, we have been talking about earlier about doji candles that look something like this. This right here is an example of a simple candlestick pattern. We also have a pattern that is called the hammer. It looks something like this. The hammer is another example of a simple candlestick pattern. Another candlestick pattern is the shooting star. It looks something like this. So this is yet another example of a simple one. But even for simple candlestick patterns like right here, if you just see a candlestick pattern appearing randomly on the chart, it doesn't actually mean a lot. The context, or in other words, where on the chart the patterns appear, is very important, and we will talk about that later on. And a complex candlestick pattern is basically a candlestick pattern that consists of 2 or more candlesticks. Sometimes it can be, even 5 or more candlesticks. But an example of a complex pattern is the bearish engulfing pattern. It looks something like this. The first candle here is green. The second candle here is red. This is an example of a bearish reversal pattern. So before this pattern appears, we have an uptrend. This pattern indicates then that the price will reverse to the downside. So all patterns that are 2 or more candlestick are complex patterns. So for example, here on the image, you can see that all of these candlestick patterns are 1 candle patterns. So these are simple patterns, and you can see that all of the 2 candlestick patterns, like all of these 3+ candlestick patterns, all of these are complex. But now, the next classification is the direction. And here, the direction can be either bullish, bearish, or neutral. A bullish pattern indicates that the price will go up after the pattern. A bearish pattern indicates that the price will go down after the pattern. And a neutral pattern indicates that we don't really know here if the price will go up or down after the pattern. However, depending on the context of the neutral pattern, these patterns can actually also tell us something about where the price will go next. So for example, remember that the doji is a neutral pattern, but if we have before the doji, let's say that we have a strong downtrend, so this right here are red candles, and then a doji pattern appears like this. In this case, even though this right here is a neutral pattern, it can actually indicate a reversal to the upside, especially if we have some sort of support right here. We perhaps have some sort of indicator that also confirms the bullish bias. The third classification we have right here is the type. And here we have reversal patterns and we have continuation patterns. A reversal pattern basically means that if we have a downtrend and then the pattern appears, so let's say that this is a random pattern, then the goal of this pattern is to reverse the price. So reverse the price in the opposite direction. While a continuation pattern means that, let's once again say that we have a downtrend, then the pattern appears. The goal of a continuation pattern is to continue the price to the downside. So for example, this pattern right here is a bullish reversal pattern because it indicates a reversal to the upside. And this right here is a bearish continuation pattern, right? Because it indicates a continuation of the trend to the downside. And we also, of course, have bearish reversal patterns, and we also have bullish continuation patterns. So we basically have 4 different combinations. All right, so now we are finally ready to start taking a look at candlestick patterns. And let's actually begin here by taking a look at the best reversal candlestick patterns. And first of all, what is a reversal pattern? Well, reversal patterns indicates a trend shift. So either from bullish to bearish or from bearish to bullish. So it can reverse the price from down to up or from up to down. And reversal patterns can be either simple or complex. And as you know, simple patterns consist of 1 candlestick, complex pattern consists of 2 or more. And here, and this is super important, the context for the patterns is very, very important. Or in other words, where on the chart the patterns appear is crucial when it comes to reversal patterns. So with these 3 rules in mind, now we are ready to take a look at our first pattern. So the very first pattern we're going to take a look at is called the bullish engulfing pattern. And as you can see here on the bottom, and I will do this for every single pattern, I list the complexity, the direction, and the type. And in this case, it's a complex pattern because it consists of more than 1 candle. It's a bullish pattern because it indicates a move towards the upside. And it's a reversal because it reverses the price from a downtrend to an uptrend. So now then, how do we identify a bullish engulfing pattern? Well, step 1 here is that we need to see a downtrend. And after the downtrend, these 2 candles appear. I hope you can see here that the candles before the pattern has a slightly different color, and also the candle here after the pattern has a slightly different color. And I will do this for all patterns. But the actual patterns are these 2 candles right here. The first candle in this pattern is a red one, and preferably we want the real body of the red one to be relatively small. It doesn't have to be super small, but it's often a good sign when we have a small real body. As for the wicks here, it doesn't matter too much. These wicks can be longer or shorter. It will not have a big impact on the pattern. The next candle of the pattern here is more important. It's this green candle right here. And in order to find a bullish engulfing, we want the next candle to be a green one, and it needs to open below the close of the red one. So it needs to open below this point right here, and the green candle needs to close above the open of the red candle. And this is why it's called an engulfing pattern, because the green candle is larger and engulfs the previous red candle. If you're trading, for example, crypto, where the closing and the open prices are at the same level, it's enough to see a pattern that looks something like this. Let's say that this is the first red candle right here, and this right here is the second candle. In crypto and some other markets, the next candle will open at the same place as where the previous candle closed. So in these scenarios, what you are looking out for to confirm a bullish engulfing is simply to see a candlestick that closes above the previous red one. When the green candle closes, then the pattern is confirmed. And as I said, the pattern indicates a reversal to the upside. Now let's take a look at the bullish engulfing pattern and how to trade it in a real market. Alright, so right here we have a chart, and remember, it doesn't really matter what time frame this chart is. I think in this case it's a daily chart, but you can use candlestick patterns on any time frame. And if you want to, you can try to find the bullish engulfing pattern on your own. So feel free to pause the video right now. Did you find the pattern? Well, the bullish engulfing pattern, at least the most obvious pattern, is this one right here. You can see that before the pattern appeared, we had a strong movement to the downside. We actually saw a little bounce, but then we saw yet another push towards the downside. The first candle is a small red one, and the next candle, the green candle, opens below, right, and closes above the previous red candle. The most common entry point is to enter when the candle closes, so at the candle close of this green candle. But where do we set our stop loss? Well, the most common level here is to set the stop loss just below the lowest point of the pattern. So in this case, the lowest point comes from this wick right here. But if the red candle has a lower wick, we usually set the stop loss below that wick. Another important point to consider when you place your stop loss is previous market structure. And what do I mean by this? Well, in this case, you can actually see that we had a low right here as well. And you can pretty much see that we have a sort of double bottom looking structure here. And when we have another low at the around same level, what I like to do is to actually place the stop loss below the sort of support created by that level. So in this case, you can see that these two lows are pretty much at the same level. But if one low is slightly lower, I like to place the stop loss below. So in this case, I would set the stop loss around here. As you also can see, I usually leave some wiggle room right here. So if the price, comes down to the support once again, we have some room for the price to bounce here before we get stopped out. But what about your target level? Well, here you can keep it simple and use a risk to reward ratio. A risk to reward ratio tells us how much do we gain compared to how much we lose when we take the trade. So for example, a risk to reward ratio of 1 to 2 means that we risk $1 for every $2 in profit. Or in other words, the distance here from the stop loss to our entry point should be half the length of the distance up to the profit target. So in this case, our profit target would be around here. Now let's switch the attention here and take a look at the bearish engulfing pattern. Once again, the bearish engulfing pattern is a complex pattern because it consists of 2 candlesticks. The direction here is bearish because the goal of the pattern is to push the price down, and this is yet again a reversal pattern. So in this case, before the pattern appears, we need to see an uptrend. Then we see a green candle appearing here with a relatively small real body. But in this case, you can see that it actually shows to put the wicks here. You can see we have a wick all the way up here and a wick all the way down here. The important thing about the first candle is that the real body is small. And even more importantly, what we want to see for the bearish engulfing is that the red candle opens above the body of the green candle and closes below the body of the green candle. So in this case, even though the wicks are above and below the real body of the red candle, this is still a bearish engulfing pattern. And when the candle closes, the pattern is confirmed and it indicates a reversal to the downside. So now let's take a look at the bearish engulfing trading strategy. And once again, feel free to try to identify the pattern on your own. In this case, the pattern is pretty clearly visible on the chart, so hopefully you can identify the pattern. Did you find it? Well, the bearish engulfing pattern is this one right here. You can see that before the pattern appeared, we had a strong move to the upside. Then we saw a small green candle, and especially the candle had a small real body. We had a pretty long lower wick, but the real body is small. Then the next massive candle came in here and opened far above the previous green candle and closed far below. So this right here is a very clear bearish engulfing. In this case, however, we did not have any resistance level. So the optimal scenario is, let's say that the high were all the way up here and perhaps we had a resistance like this. This would be the optimal scenario. The bearish engulfing pattern is more significant when it happens at a resistance level, but you can still use the pattern on its own. You can, for example, combine the pattern with other technical variables like indicators and market structure. But okay, so what about the entry point? Well, once again, the most common entry for the bearish engulfing pattern is to enter at the candle close of the red candle. The stop loss we usually place above the highest point of the pattern, and in this case we can see that the highest point is right here. Once again, you can see that I leave some space here for some wiggle room. And as I said, remember to keep other market structure in mind. So for example, if we have a resistance all the way up here, you might want to set your stop loss above that resistance. As for your target level, to keep it simple, we usually use a risk to reward ratio. A very common risk to reward ratio is to use a 2 to 1. So we measure this length right here, and our target length should be twice as long from the entry. So in this case, our target would be right around here. Another interesting thing to notice about this chart is, let's actually take a look at this pattern right here. Well, here we actually have a bullish engulfing, because the first candle is a red one, the second candle is a green one that opens below, right? Opens below the body and closes above the body of the previous red candle. And we can actually see that this bullish engulfing pattern marked the low of this down move, and it actually reversed the price here to the upside. All right, so now the time has come to take a look at one of my personal favorite patterns, and this right here is the hammer pattern. This pattern is a simple pattern because it consists of only one candlestick. The direction here is bullish and the type is reversal. So to identify a hammer pattern, what we first need to see, remember, it's a reversal pattern. So before the hammer appears, we need to see a move towards the downside. Then the actual hammer appears, and that is this candle right here. To find a valid hammer pattern, what we're looking out for is that we're looking out for a small real body, like right here, and we're looking out for a long lower wick. And specifically, what we want to see here is that the wick, the lower wick of the pattern, should be at least twice the size of the real body. And preferably, it should be, you know, maybe 3 times or even 4 times as large as the real body. You can see in this case, the wick is maybe 3 times as large. So this right here is a good hammer. Another thing about the hammer is that we want the upper wick right here to be preferably very small, or the best case scenario here is when we have pretty much no wick at all. So if we have a pattern that looks, you know, like this, and we have no wick, this right here is a perfect hammer. And another thing that might sound a bit counterintuitive is that the color of the pattern can actually be either green or red. So it doesn't have to be a green real body, it can be red and still be a valid hammer. So a hammer can look something like this with a red real body. However, if we, you know, have to choose between these patterns, the green hammer is more bullish and is a stronger signal. So preferably we want to see a green candle. And once again, when the candle closes, the pattern is confirmed and it indicates a reversal to the upside. So now then, let's take a look at the hammer pattern trading strategy. And here on the chart, we actually have 3 valid hammer patterns. So once again, if you want to, pause the video and try to identify the patterns. All right, so the first hammer we can identify is this candle right here. You can see this green candle that has a pretty small real body and a long lower wick. And the important part about this candle is that you can clearly see that the wick here is more than twice the size compared to the real body. And here you can also see that before the hammer appeared, we actually saw a massive drop towards the downside. So when we see a very strong movement before the hammer appears, it can actually make the hammer even stronger. This right here is a very strong reversal signal. But what about the other hammers? Well, right here, we actually have another hammer. This one is a bit more, you know, debatable if this is a hammer or not. But what you can see, first of all, is that we do have a small real body. And you can also see that the lower wick of this pattern is clearly more than twice the size of the real body. But what makes this pattern a bit shaky here, or, you know, some people might not consider this a hammer, and that is because the upper wick here is pretty long. But in my opinion, I would probably still consider this a hammer because the lower wick is so much longer compared to the upper wick. So this could still be considered a hammer. And what we also can notice is that before the hammer appeared, we saw a strong move towards the downside, and that is a good sign. Another candle that you might consider a hammer is this candle right here. You can see once again, we have a very small real body and we have a long lower wick. But in this case, I would actually not consider this a hammer, and that is because we are actually in a move towards the upside. Yes, we have a small move here before the hammer appears, but this is not really enough for me to consider this a reversal pattern. Preferably before the pattern appears, we want to see a clear move here towards the downside. But the last valid hammer pattern here, in my opinion, is this one right here. Once again, you can see we have a very small real body, we have a very tiny upper wick, right? And we have a very long lower wick. The body is red, but remember, that doesn't matter. This is still a valid hammer. So in this case, what about the entry point, the exit point, and our target level? Well, once again, and this is common for many patterns, the most common way to enter is to enter at the candle close here of the pattern. And remember, this is a red body, so we enter at the lowest point of the body. That is when the candle closes. But what about the stop loss? Well, in this case, you can actually see that we have some sort of support because we have a low right here, we have another low right here, and we have another low right here. So what we can do here is that we can drag a sort of support area. I prefer to draw areas rather than sort of lines. In this case, we can draw a pretty broad support area right here. And in this case, I think it makes sense here to place the stop loss below the support area. And I also leave some wiggle room. So I leave some wiggle room here between the support and the entry point, just like this. And as for our target level, once again, we can keep it simple with a 2-to-1 risk to reward. We measure this part. Our target level should be around twice the length of this part right here. And that would give us a target around here. Once again, when it comes to target levels, we can also use support and resistance levels. So in this case, we can see that we have some sort of resistance, resistance, resistance. So here we have some sort of resistance area right here. So it can make sense when you have a resistance area like this to actually place the target just below, wrong tool here, just below the resistance. So in this case, you can actually, adjust your support, So in this case, you can actually adjust your target a bit here to take targets before the resistance appears. Because when we reach a resistance, it's pretty common that the price will reverse. In this case, you can actually see that we did get a pretty strong reaction of this resistance area. It went a tiny bit higher here, but definitely keep support and resistance levels in mind. All right, so now let's take a look at the shooting star pattern. This is one of my favorite bearish patterns, so make sure to really pay attention to this one. Once again, this is a simple pattern because the pattern consists of one candlestick, the direction is bearish, and the type is a reversal. And because this is a bearish reversal, that means that before the pattern appears, we want to see an uptrend. Then this right here is the actual pattern, and after the pattern, the goal is to reverse the price to the downside. To identify a shooting star pattern, we want to look out for a small real body and a long upper wick. What we also want to see is that we want the lower wick to be either non-existent or to be very small, like we're seeing right here. And here, and this is very important, the upper wick of the shooting star, just as the hammer, we want this one to be at least twice the size, or preferably even longer compared to the real body here. And in this case, we can see that the upper wick is just barely twice the size as the previous candle. So if this wick was a little bit shorter, so if we had a pattern that looks something like this instead, where the upper wick is, maybe like this, now we are not really seeing a shooting star anymore. So when you're looking out for shooting stars, definitely pay close attention to the upper wick of the pattern. Alright, so now then, how do we trade the shooting star? Well, in this case, the shooting star can actually be pretty hard to spot. But the most valid shooting star right here, in my opinion, is actually this green candle right here. And I actually forgot to mention this, but for the shooting star, it doesn't matter if the body is green or red, it's still a valid shooting star. However, a red candle is a bit more bearish. But the important part here is that we have a small real body and a long lower wick. In this case, you can see that the wick is just barely twice the size of the real body. And what we also can see is that before the pattern appeared, we had a clear move towards the upside. As for your entry level, once again, we enter here at the candle close of the pattern. And because this is a green body, we enter at the top of the real body. Your stop loss level here, once again, we want to look out for previous market structure. You can see that we actually have a high right here. So we can drag a resistance like this. In this case, we can actually see that the shooting star just quickly peaked above the resistance and then reversed. This is actually a special type of pattern that we call a Wyckoff upthrust. And these can be very strong reversal signals. And by the way, guys, if you want to learn more about support and resistance and how to combine support and resistance with other technical tools to create a trading strategy, I highly recommend to watch my support and resistance trading course here on the channel. I will make sure to link that video up in the corner in the eye. So now then, where do we place our stop loss? Well, because the highest point of the shooting star is above the resistance, we actually want to place the stop loss just slightly above that point. Once again, I leave a tiny bit of wiggle room between the highest point of the shooting star and the stop loss. And as for our target level, we keep it simple with a 2-1 for this pattern as well. So we measure this move right here. And we take a 2-1, so the target should be twice the size, and we lock in our profits around here. In this case, we can see that the price actually continued further down, but that is no guarantee. So it's very important to plan out your trade, set your, stop loss and set your target and stick to your plan. Another interesting thing you can notice about this chart is that we pretty much had a shooting star pattern appearing right here, right? You can see we had a small real body, we had a long upper wick, but what makes this pattern a bit, shaky is that, yes, we saw a move towards the upside right here, but before the shooting star appeared, we had more of a sideways movement. A more valid pattern, in my opinion, would have been this candle right here. But in this case, you can see that if you traded this pattern, you would have entered right here, and you would have probably set your stop loss right here. So in this case, this would have been a losing trade. And that is a very important point to consider. Not all patterns will be successful. Some patterns will fail, and then it's very important to respect your stop loss and exit the trade without any hesitation. Another important thing to remember here is that when we use a risk to reward ratio of 1-2, this means that we can actually lose more trades than what we win and still make money. So losing trades doesn't have to be a bad thing. It's simply a part of the game. Alright, so now it's time for a very iconic and pretty complex reversal pattern, and this is the morning star pattern. This pattern right here is indeed complex, and it's a bullish reversal pattern. So before the pattern appears, we want to see a downtrend. Then the actual pattern appears here, and as you can see, this pattern consists of 3 candlesticks, and the goal of this pattern is to reverse the price to the upside. So how do we identify the morning star? Well, the first candlestick of the morning star is a pretty strong red candle, and it's a continuation of the previous move towards the downside. The next candle is a green candlestick with a small real body, and the wicks here can be either small or long. But here, and this is very important, between the candle close of the red candle and the opening of the green candle, so in this space right here, we actually want to see a gap. A gap is when we either have distance between the bodies of the candle, or another gap, which is called a wick gap, is when we actually have distance between the wicks of the candles as well. And I will talk more about that later on in this video. We actually have some patterns where we need to see wick gaps, but in this case, all you need to see is that we want to see a gap between the bodies of the candles. And the third and the final candle of the pattern is a strong green candle. And here we once again want to see a gap between the small green candle and the large green candle. So we want to see a gap between the real bodies of these two candles. Yet another thing we want to see with the green candle is that preferably we want the green candle to close well within the real body of the red candle. And a rule you can use, if this right here is 50% or in other words, it's in the middle of the red candle, we want the green candle to close above this mark right here. And when the green candle closes above the 50% mark, the Morningstar pattern is confirmed. Alright, so now let's take a look at the Morningstar trading strategy. And the Morningstar can be identified right here. And this one can be a little bit tricky to spot here, but let's take a look at this pattern together. So the first candle is a strong red candle that clearly comes after a downtrend, a very strong movement here towards the downside. The second candle of this pattern has, first of all, it has a very small real body. That is a good sign. And you can see here that we actually have a pretty long lower wick. So what pattern is this pretty much? Well, it's actually pretty much a hammer pattern. So you can actually find a hammer pattern inside a Morningstar pattern. And it's a bit hard to see here, but we actually created some space between the real body of the first candle and the second candle. Between candle 2 and candle 3 here, we have a much clearer gap here. You can see we clearly have a gap between the red candle and the green one. And what you also can notice here is that the green candle closes above. The candle close here is above the 50% mark of the first red candle. So as for our entry point, the most common way to enter is to enter at the candle close of the shooting star, so to enter right there. In this case, when we have a hammer pattern, you could have actually entered all the way down here on the hammer as well. But in this example, we are showing off the Morningstar, so let's stick with entry example number 1. Let's take a look at our stop loss here. We don't really have any clear support level, and when we don't have any clear support, we usually place the stop here below the lowest point of the pattern. So we place it below this point right here. We also leave some wiggle room space between the low and the stop loss. So if the price falls down here, we can actually retest the hammer pattern and still, not get stopped out. As for your target level, we can keep it simple and use a 2-1. This would give us a target around here. Or we can actually use previous market structure. So in this case, you can see that we have a pretty clear resistance all the way up here. You can see we have 1 touch, 2 touches. So it's actually possible to set your target just below that resistance. I'm not really sure here, but if I remember correctly, I do think that we saw a move towards the upside and then down, and then this target eventually got reached. Alright, so now let's take a look at the evening star pattern. The evening star is a complex pattern because it consists of 3 candlesticks. The direction is bearish, and this is once again a reversal pattern. So before the pattern appears, we have an uptrend. Then the actual pattern is this one right here, consisting of 3 candles, and the goal of the pattern is to reverse the price to the downside. The first candle of this pattern is a strong green one. So we want to see a long body here, and we can also see some wicks. The important part about the first candle is that we have a long green body. The next candle is a candle with a small real body. So in this case, you can see that we have a very small real body here. We can also have both lower and upper wicks. This is not super important. The most important part here is that we have a small real body. We can even have candlesticks that looks something like this, where the real body is so small that you can't even see it anymore. This right here is a doji candle, and we will talk more about doji candles and why they are so important later on in this video. And also this candle can be either green or red, but one could consider the pattern a bit more bearish if we see a red candle. Between the body of the first candle and the second candle, and this is very important, we need to see a gap. So between this point and this point, we want to see a gap here between the real bodies. The third candle here is a strong red candle. And once again, between the real body of candle 2 and the real body of candle 3, we want to see a gap like this. And to confirm that the third candle is strong and to confirm the pattern, we want the red candlestick or candle 3 to close below this point right here. And in this particular example, you can see that the red candle closed far below the 50% mark, and this confirms the evening star pattern. Alright then, so how do we actually trade the evening star? Well, the first thing we need to do is of course to identify the pattern. So if you want to, try to do this yourself and pause the video. Did you manage to find the pattern? Well, the evening star is this pattern right here. You can see that the first candle is a strong green one that comes after a move towards the upside. The second candle right here has a small real body. In this case, the real body was green, but remember, the body can be either green or red. And this pattern on its own is actually something we call a hanging man pattern, and we will cover that pattern later on in this course. But for now, all we need to notice is that we do have a small pattern, and also, very importantly, we do have a gap here between the real body of the green one and the real body of the first candle. So you can see we have a pretty clear gap right here. The third candle is a strong bearish candle. That's exactly what we want to see. And even though it's tiny, we can see that we do have a gap here between candle 2 and candle 3. And also the red candle closes below the 50% mark of candle 1. So you can see that the candle close is clearly below that point. So we have all our criteria and this pattern is confirmed. As for your entry point, we usually enter here at the candle close of the third candle, and for the stop loss, once again we don't really have any clear support and resistance here, so our stop loss we want to place above this point. So we place it above, we leave some wiggle room right here, and we use a risk to reward ratio. We can use, for example, a 2-to-1. We could also use a 3-to-1. A 3-to-1 risk to reward simply means that the reward, the length down to the target, so the length down to this point right here, should be 3 times as long as this length right here. Alright, so now the time has come to take a look at the piercing pattern, and the piercing pattern is yet another super useful reversal pattern. And this pattern is complex because it consists of 2 candlesticks. The direction here is bullish, and as I said, the type here is reversal. So before the pattern appears, we need to see a downtrend. Then these 2 candles right here are the actual pattern, and the goal of the pattern is to reverse the price to the upside. The first candlestick of this pattern is a red one, preferably a pretty strong red candle, but it can be either strong or sort of medium strength. And the red candle is a continuation of the previous move to the downside. The next candlestick is a strong green candle. It can have an upper wick and a lower wick. But the most important thing about this green candle is that we need to close above. Remember, just as with the morning and evening star, we have this 50% line from the red candle. And this line goes from the middle of the previous red candle. And what we want to see in order to confirm the piercing pattern is that we want the green candle to close above this line. When we see the candle close, the pattern is confirmed and indicates the reversal to the upside. What I also forgot to mention here is that the red previous candle can also have an upper and a lower wick. So now let's take a look at the piercing pattern trading strategy. And as always, you can, as an exercise, try to find the pattern here on your own. But the piercing pattern can be found right here. You can see that before the pattern appeared, we had a pretty significant move here towards the downside. Candle 1 here is a strong red candle. We have a slight upper wick and lower wick, but that's okay. The next candle here is a strong green candle. You can see that we do have a very long lower wick and we do have a very long upper wick, but that's completely fine. Because remember, the most important part about this pattern is that the green candle needs to close above this 50% line we have right here. And you can see that the candle close was quite far above the 50% line. So when this candle closes, the pattern is confirmed. Another important thing to notice about the piercing pattern is that this is pretty much an early stage of a bullish engulfing. Because if the piercing pattern pushes a bit higher here, and closes above the opening of the red candle, then we actually have a bullish engulfing pattern instead. So this is pretty much an early sort of bullish engulfing pattern. But now let's take a look at where do we enter, where do we set our stop loss, and where do we place our target. Well, the most common entry point is as usual at the candle close. So we enter here when the pattern confirms. As for our stop loss, we usually look at the very lowest point of the pattern, and in this case, remember, we have a very sort of long lower wick. So what we usually do is that we actually set the stop loss all the way down here, all the way below the lower wick. And I also, like, as you know by now, I like to leave some wiggle room here. This allows us for the pattern to go down and test the low once again and then bounce, and we will still not get stopped out. And as always, you also want to look out for the previous market structure. In this case, you can see we have a low right here. And we have a lower low. In this case, we don't have an indicator right now, but just by looking at the price, I can actually sense a sort of divergence right here. If you want to learn more about divergences to improve your candlestick pattern trading even more, I actually have a full course about the RSI indicator that I highly recommend watching. I will make sure to leave a link to that video somewhere up in the corner. But now then, what about the target? Well, our usual method here is to measure the length between the entry and the stop loss, and we use a risk to reward ratio. A risk to reward ratio of 2 would give us a target maybe somewhere around here. So this is where our target is and where we lock in profit. Alright, so now we're going to take a look at the dark cloud cover. This right here is an important bearish pattern that every trader needs to know about. This pattern is complex because it consists of 2 candles. The direction is bearish and the type is reversal. So before the pattern, we want to see an uptrend. These 2 candles right here are the actual pattern, and the goal of this pattern is to reverse the price down. The first candle of this pattern is this candle right here, and this is a pretty strong green candle. It can be either very strong or medium size. It doesn't matter here if we have an upper wick and a lower wick. The most important part here is that we have a clear continuation of the uptrend. The next candle, candle 2, is a strong bearish candle. And in this example, you can see that we have no upper wick, and this is completely fine, but we have a pretty long lower wick, and that's also completely fine. The wicks of this pattern are not the most important part. The most important part is that the red candle needs to close below this 50% mark of the green candle. So once again, the 50% mark is drawn from the middle of the body of the green candle, and what we're looking out for here is that we're looking out for a candle close below this line. When we see a candle close below the 50% line, the pattern is confirmed and indicates a reversal. So now then, let's take a look at the dark cloud cover trading strategy. And the first thing we need to do is that we need to identify the pattern, and the dark cloud cover can actually be found right here. And this right here is pretty much a special case of the dark cloud cover, because the second candle here is, you know, a massive candle. And as you can see, first of all, we had a very clear move towards the upside before the pattern appears. And the first candle here is a pretty strong green one, and importantly, it's a continuation of the uptrend. In this particular case, we have no upper wick and we have no lower wick, but that's completely fine. The second candle in this case was a massive bearish candle. And the very interesting thing about this candle is that during the candle, the price pushed all the way up here. But before the candle closed, the bears managed to push the price all the way down here. And even more importantly, the bears managed to push the price and close below the 50% mark of the previous green candle. So this actually confirms that we have a dark cloud cover. And even though we have such a large candle and such a large upper and lower wick, this is still a dark cloud cover. But now then, how do we trade a dark cloud cover with, you know, such a big bearish candle? Well, the first step is to find our entry point here. And once again, the most common entry is to enter here at the candle close of this pattern. But as for the stop loss, here it gets a bit more tricky. We still have the most common stop loss, that is, you know, if we take a look at the absolute highest point of the pattern. As you guys know from previous patterns, the most common way to set your stop loss is to set your stop loss just above this point. But now, since the highest wick is so high up, some traders highly prefer to not have such a wide stop loss. So when you see a large second candle, like we're seeing right here. Another method to set your stop loss is to actually place it above the candle close of the pattern. So some traders might prefer this stop loss. You can see we set the stop loss just above the real body of the pattern. And as always, we also leave some wiggle room. So here you have two pretty valid options for your stop loss. You have the higher stop loss and you have the lower stop loss. And what stop loss you decide to choose here basically depends on your own trading style. If we choose the lower stop loss, then our target level using a 2-to-1 would probably take us down around here. So this right here is target 1. But if you're using the wider stop loss and still aim to get a 2-to-1 risk to reward ratio, you also of course have to increase the target. So in this case, your target level might be all the way down here. Alright, so the next pattern we're gonna take a look at is the inverted hammer pattern. And this pattern is, very important to understand because it can be quite counterintuitive. Because this right here is a simple bullish pattern and it is a reversal pattern, but many, especially new traders, look at this pattern and say, isn't this a bearish pattern? Well, it's actually considered a bullish pattern. And we will talk about why this is considered a bullish pattern very soon. But first, how do we identify the pattern? Well, since this is a bullish reversal, before the pattern, we need to see a downtrend. And in this case, the context is very important. So it is important that we have a down move before the pattern. Then the actual pattern appears. And the goal of the pattern is to quickly push the price towards the upside. The pattern itself consists of one single candle with a very small real body and a long upper wick. And here, just as with the hammer pattern, we want the wick to be at least twice the size compared to the real body. And in this case, you can see that the wick is maybe, 4 times as large as the real body. So that is a very good sign. But now you may of course wonder, why is this even a bullish pattern? Because if you remember from earlier in the video when we talked about the shooting star, you can actually see that this right here is the same candle as the shooting star. Because as you can see, the candle opened all the way down here. During the candle, the bulls started off good. They managed to push the price all the way up here. But before the candle closed, the bears took control once again and pushed the price all the way down to this point right here. But the reason this is still considered a bullish pattern is because of the context. Because before the pattern appeared, we had a clear move towards the downside. And because the bulls during the next candle managed to push the price all the way up here, this gives us an indication that the bears from the downtrend might be losing control. So if you see this pattern appear after a downtrend, it's a bullish pattern. But if you see the pattern appear after an uptrend, it's a bearish pattern. So the context is very important. But when this candle closes, the candle is confirmed and indicates a reversal to the upside. When trading the inverted hammer, many traders will actually wait for a confirmation candle. And what is a confirmation candle? Well, in this case, this right here is a confirmation candle. It's a candle that appears after the pattern that confirms the direction we want to see. And in this case, we want to see a move towards the upside. And we can see here that the next candle confirmed this move. So some traders will wait for this next candle close before they enter their trade. And in my opinion, waiting for a confirmation candle when it comes to the inverted hammer, it's not a bad idea. Because this pattern is, slightly less bullish compared to, for example, the hammer pattern. And as you can hear on the name, the inverted hammer pattern is basically a hammer upside down. So now let's take a look at the inverted hammer trading strategy. And if you want to, pause the video and try to find the pattern on your own. Did you guys succeed? Well, the inverted hammer here can be pretty hard to spot, but it can be found right here. You can see that before the inverted hammer appeared, we had a pretty significant move towards the downside. Especially the last candle here before the inverted hammer was a very strong bearish one. Then, as you can see right here, we saw an inverted hammer appear. Why is this an inverted hammer? Well, we have a small real body and a long upper wick. And this wick needs to be at least twice the size of the real body. And in this case, we can see that it is slightly more than twice the size of the body. But how do we actually trade this pattern? Well, in this case, we have two different ways to enter. The first potential entry point is to enter here at the candle close of the inverted hammer. But as we talked about, a second way to enter is to wait for a confirmation candle. In this case, this next green candle here is a confirmation candle. It confirms the pattern because it pushes in a bullish direction. And that is exactly what this pattern indicates. And what about our stop loss level? Well, the most sensible stop loss point here, at least in my opinion, is to look out for the lowest point of the candle that happened before the inverted hammer. When you see candles like this that wicks below the actual pattern, before the pattern appears, a good way to set your stop loss is to place it below this point. And also, of course, I leave some wiggle room here. So if the bears take control here, we actually have a chance of a bounce at the low and still not get stopped out. As for your target level here, if you use the first entry, you can see that we have a very tight stop loss. This is something that, some traders prefer and some traders like to avoid. And when we use such a tight stop loss, you can see that if we use our risk reward ratio of 2, you can see that our target gets reached very, very quickly. So if you are a trader that likes to get in and out of the market quickly, tight stop losses can be a good idea. If we instead use the confirmation candle entry here, we will have a much wider target. If we once again use a risk reward of 2 to 1, you can see that our target would probably be somewhere up here. And this is a pretty interesting point because this, as you can see, between this candle and this candle, we actually had a very large gap. And we will talk more about price gaps later on in this video. But a common principle here is that price gaps tends to be filled. So the highest point of the gap here can actually many times act as resistance. So it does make sense here to set your target level here just before the gap close, or in other words, before the resistance. Because when the price reaches, or if the price reaches all the way up there, it's very possible that we can actually see a reaction. Alright, so now let's take a look at the hanging man pattern. The hanging man is a pretty wild name here, but the pattern is a simple pattern. It consists of only one candlestick. The direction here is bearish and the type is a reversal. So before the pattern appears, we have an uptrend. Then this right here is the actual pattern. And the goal here is to reverse the price to the downside. And the hanging man pattern is another pretty counterintuitive pattern, because as you can see, this pattern actually looks like a hammer, right? It's pretty much the exact same candle as a hammer. The key difference between the hanging man and a hammer pattern is the context. So where on the chart does the pattern appear? And in this case, it's very important that in order to have a hanging man, it needs to appear after an uptrend. The pattern itself consists of a small real body and a long lower wick. And what we want to see here is that we want the wick here to be at least twice the length of the real body. So at least twice the length here. In this particular case, it looks to be more like 3 times, and that is a good sign. But why is this a bearish pattern? Well, remember here that before the pattern, we have an uptrend, and then the pattern appears here. And during this pattern, we can see that the bulls actually took lots of control and managed to push the price all the way down here. We can actually see that in this particular case, the bulls actually quickly managed to break the lowest point of the previous candle, but before the candle closes, the price pushed all the way up here. So even though the bulls took control here, this is still a bearish pattern, because the bearish move all the way down here shows a clear disruption in the uptrend. And just as with the inverted hammer, some traders, when they see a hanging man, wants to see a confirmation candle. So they find this pattern confirms with the candle close, but then they wait for one more bearish candle before they actually enter the trade. And also the color of the real body can actually be either red or green. But for the hanging man pattern, I personally highly prefer when we see a red body, because if we see a green body, it's very possible that this move is just a continuation of the uptrend. Alright, so here we have a real life example of the hanging man pattern, and this chart right here can be, you know, pretty hard to read, so it's pretty impressive if you can find the hanging man pattern on your own here. So where's the hanging man? Well, we can identify the hanging man right here. And one reason why this hanging man is hard to spot here is because the move, you can see before the pattern appeared, we did have a strong move here towards the upside. But you can see that we actually have a slightly bearish candle just before the pattern appears. And this right here is something we actually don't prefer. We prefer to see a green candle before the hanging man. But the most important part here is that the overall move before the hanging man is a move towards the upside. And here we can still see that the overall move before the pattern is an upwards movement. And if we take a look at the actual pattern, we can see that we have a small real body. The body is red, so that is a good sign. And we also have a long lower wick that looks to be around 3 times the size of the real body. When it comes to the entry point for this pattern, it can also be a little bit tricky. As always, the most straightforward entry point is to enter right here at the candle close of the hanging man. But remember that the other strategy was to wait for a confirmation candle. And you can see that this next candle right here was a red candle, but this is actually not a confirmation candle, because in order to be a confirmation candle, we want to confirm a move towards the downside after the pattern. And in order to confirm a move towards the downside, we want to see, you know, a candle that at least closes lower than the hanging man. So this candle is not good enough to be a confirmation candle. However, if we take a look at the next candle here, we can see that the price gapped down. You can see we created a gap here between these two candles, and we clearly pushed lower. So in this case, the second entry would actually be all the way down here, at least in my opinion. But what about our stop loss level? Well, here we also have some important market structure. You can see we have one high right here, and we have another high right here. So here we can actually mark up a resistance area on the chart. And when a bearish pattern appears at or very close a resistance level, what I like to do is to place the stop loss just above the resistance, because then we can allow for the price to go up here and get rejected and still be within a winning trade. But what about our target level? Well, as usual, we want to measure the distance between the stop loss and the entry point. And if we use a risk to reward ratio of 2, our target would be somewhere around here. And if we use a risk to reward ratio of 3, then our target would be somewhere down here. Your choice of risk to reward will depend a bit on your trading style. A lower risk to reward, like a 1 to 2, will make it more likely that your trade succeed. But if you use a risk to reward of, for example, 1 to 3, like we do right here, it will be less likely that your trade succeed. But when you actually get a successful trade, you will win much more. Alright, so now it's time to switch the attention and take a look at the best continuation candlestick patterns. And first of all, what are continuation patterns? Well, continuation patterns indicate that the trend will continue. Or in other words, they indicate that we will go from a bullish to a bullish trend, or from bearish to a bearish trend. And continuation patterns can be super effective because you are trading in the same direction as the trend. And as you guys know, the trend is your friend. When it comes to continuation patterns, the patterns are often complex. Or in other words, the patterns will very seldom consist of only one candlestick. They will pretty much always be, a bit larger patterns. And when it comes to continuation pattern, the location on the chart, or in other words, the context of the patterns are super, super important. So when we talk about continuation patterns, make sure to, pay extra attention to the context and location of the patterns. Okay, so let's take a look at the rising 3 methods pattern. And as you guys can see, this right here is a pretty large pattern, so it's definitely a complex pattern because this one consists of 5 candlesticks. The direction of this pattern is bullish and the type here is continuation. So it's very important that before this pattern appears, we need to see an uptrend. Then all of these candles together are the actual pattern, and the goal of this pattern is to continue the trend towards the upside. And the first candle of the rising 3 methods is a strong bullish candle. And this pattern indicates that the bulls are still in control of the uptrend. But after this candle, what we are looking out for here is that we are looking out for 3 small bearish candles. So we're looking out for a small move that goes in the opposite direction of the trend, or in other words, we're actually looking out for a small pullback. And these 3 candles should preferably be within this range. So if we take from the highest point to the lowest point of the previous bullish candle, we want the red candles here to be within this range. As for the wicks here of the small red candles, it's okay here to have wicks on all of these candles. The important point here is that we want to have small real bodies of these candles. The last candle of the rising 3 methods is very important. Here we want to see a strong bullish candle. And what we want to see here is that we want this bullish candle to close above the close of the first candle. So you can see right here we have the close of the first candle, and we want the final candle to close above this line. When we get this candle close, the rising 3 methods is confirmed and indicates a continuation up. Okay, so now, how do we actually trade the rising 3 methods? Well, the first thing we need to do is that we need to identify the pattern. And the rising 3 methods can actually be found right here. First of all, you can see that before the pattern appears, we have a very strong movement towards the upside. Once again, you can see that we actually have a gap here. We have a massive gap, and we will talk more about gaps later on in this video. It's important to learn about the gaps, but for now, let's focus here on the rising 3 methods. And we can also see here that the first candle is a strong green candle. In this case, we have, a pretty long wick, but that's completely fine. The next 3 candles, you can see here that we have 3 small red candles with very small real bodies, and that is exactly what we want to see. But here, and this is actually on the edge, we can see that the third red candle is almost pushing a bit too low here. If we take a look here, we can see that the real body, the red real body is contained within the first green, and that is exactly what we want to see. I think I forgot to mention this in the previous slide, but you can see that the important part here is that the real bodies of the red candles should be contained within this range. It's not the end of the world if we have a lower wick right here, but preferably we want at least the real bodies of the candles to be contained within that. Last but not least, we have the final candle, and remember, in order to have a valid rising 3 methods, we want that final candle to close above this line right here. And here you can see that this candle just slightly managed to close above that point, and that confirms the rising 3 methods. As for your entry point, the most common way to enter is to enter here at the candle close of the last candles. Some traders wait for a confirmation here, but because this last candle is a strong bullish one, I definitely don't think you need to wait for a confirmation for the rising 3 methods. Entering at the candle close of the 5th candle is often a good idea. As for your stop loss, the most common way to place it is to place it below the lowest point of the whole pattern. And in this case, you can see that the lowest point of the whole pattern is right here. But sometimes the lowest point of the pattern will actually be created from the first candle as well. So here you need to be a little bit flexible. But in this case, because we had the third red candle wicking below, we actually have the stop loss placement right there. I always leave some space here for some wiggle room, so I set my stop loss around there. To get your target level, here we actually have, because we have a continuation pattern, we have many different methods. The first method is to use a fixed risk to reward, so we measure this movement. If we use a 2 to 1, our target will be right around here. But when it comes to continuation patterns, we can also use something called a measured move. So what we basically do is that we measure the whole impulse that created the whole sort of move towards the upside before the pattern. And then we take this exact measurement and measure the same length. So the length of this arrow and this arrow should be the same length. And then we take our target all the way up here. This method is something called the 100% measured move. And I talk more about that in our market structure trading course here on the channel. All right, so now it's time to take a look at the falling three methods pattern. And this right here is a pretty large pattern consisting of 5 candlesticks. Or in other words, it's a complex pattern. The direction is bearish and the type is continuation. So before this pattern appears, we need to see a downtrend. Then we see the actual pattern, and the goal of the pattern is to continue to push the price down. The first candlestick of the pattern is a large red candle, or at least a medium length red candle. And this candle is simply the continuation of the previous downtrend. It's okay to have an upper wick and it's okay to have a lower wick, and it's not too important if these wicks are long or short. After the first candle, what we're looking out for here is we're looking out for 3 small candles that goes in the opposite direction. Or in other words, we're talking about a pullback. These candles can also have wicks. For example, this candle right here, you can see have pretty large wicks. And to be specific, this right here is actually a spinning top candle, and we will talk more about spinning tops and why they are important later on in this video. But the important part about these 3 candles is that the real bodies of these candles should be contained between the low of the first candle and the high of the first candle. It's fine if we do see a wick below or even a wick above, but preferably we want all of the bodies of the candles to be within this range. The final candle of the pattern is yet another strong bearish one. Once again, we can have wicks on this candle, but the most important part here is that the 5th candle closes below the candle close of the first candle. So the candle close of the first candle is right here. So we want the last candle to at least close below this point. And you can see in this particular example, we got a candle close far below the close of the first candle. So that is a very good sign. This final red candle indicates that this sort of pullback is over and that we are likely to see a continuation to the downside. Alright, so now let's take a look at the falling 3 methods in a real market. And as always, the very first thing we need to do is to identify the pattern. You can try to identify the pattern on your own and pause the video now. Did you find the pattern? Well, the falling 3 methods can be found right here. You can see these 5 candles. As we can see here, the first candle is a strong bearish candle, and this is a continuation of the downtrend. Next, we have 1, 2, and 3 small green candles that creates a pullback or consolidation within the downtrend. And remember here, we want the real bodies of these 3 green candles to be contained within this range. And here we can see that all of these green candles are indeed in this range right here. The final candle should be a strong red candle, and we can see that we found a strong red candle right here. And remember, this candle needs to close below the close of the first candle. So we need to close below this point, and here we can once again clearly see that we got a candle close below. So now then, where do we enter and where do we place our stop loss and where do we take our profits? Well, the entry point is pretty straightforward. The most common entry point is to enter at the close of the 5th candle. So you enter right here. And as we have been talking about, some traders wait for a confirmation candle, but for the following 3 methods, I think personally that the best entry point is just to enter at the 5th candle. As for your stop loss, you want to place your stop loss above the highest point. So here, this right here is the highest point of all the candles within the pattern. So we place our stop loss just above this point, and we also leave some wiggle room right here. As for your target level, you can either keep it simple with a risk to reward ratio. So you measure this length right here, you take this measurement, you double it, and your target will be somewhere around here. yet another way to take targets is to measure the whole impulsive move down, and then you take this exact measurement and you measure from the high of the pattern and you take the target down here. So in this case, the second target would be a little bit earlier, right around here. The important thing about this second target method is that the length of this move and the length of this move should be equal size. Alright, so the next pattern we're going to take a look at is the bullish momentum pattern. And this right here is one of my favorite patterns because it's pretty easy to identify and they can also provide very strong signals. So let's first take a look at this pattern. So this pattern we can actually consider a simple pattern because the actual pattern is only one candlestick. However, it's very important that we compare this candlestick with the previous candles, and I will talk more about that later on. And as we can hear on the name, this right here is a bullish pattern, and this right here is a continuation pattern, I would say, but you can actually also use this pattern as a reversal pattern, but most commonly I would say it's a continuation pattern, so let's classify this as a continuation. So before this pattern we preferably want to see an uptrend, but after this uptrend the price should enter a sort of sideways or consolidation phase. This movement can be slightly upwards, or it can actually also be sideways or even slightly downwards. Then the actual pattern appears, and the goal of this pattern is to continue the price upwards. And how do we identify this pattern? Well, what we're looking out for here is that we're looking out for a strong green candle, so we want the real body of the candle to be very long. The upper wick, we can have an upper wick and we can have a longer wick, but for the momentum pattern I actually prefer if we have shorter wicks, but we can have longer wicks as well. But the most important part about this pattern is that we want this candlestick right here to be at least 2 times as large as the real bodies of the previous candles. And here the question is, of course, how many candles should we measure? Traders have slightly different methods, but I recommend that you measure at least 3 candles before the pattern appears. So we want the candle to be twice the size, the real body should be twice the size as at least the 3 previous candles. I hope this doesn't sound confusing, but what we basically do for this pattern is that we compare the size of the candlestick bodies. So now let's take a look at a bullish momentum trading strategy. And as always, the first thing we need to do is to identify the pattern. So remember, to find a bullish momentum candle, we need to compare candles with previous candles. And actually, if you look at this candle right here, you can see that this right here is a pretty strong bullish candle. It's, for example, it's not as strong as this candle and not as strong as this candle. But what is important about this candle is that the real body is twice the size compared to all of the previous candles. So we can actually consider this right here a bullish momentum candle. And another thing that is very important in this case is that we actually have, you can see we have a pretty clear resistance level right here. You can see the price got reacted, 1 time, 2 time, 3 time. And here the price was just hovering very close to the resistance. And another thing we can notice is that the price is actually printing, as you can see, higher lows into the resistance as well. So in this particular case, it looks like we actually have some sort of ascending triangle pattern. And by the way, guys, if you want to learn more about chart patterns, I actually have a full chart pattern trading course here on my YouTube channel. So I will make sure to link that video somewhere up in the corner in the eye, and I highly recommend that you guys check that video out after you are done with this video. But now then, so how do we trade this pattern? Well, the most common method is to simply enter at the candle close of the momentum candle. Some traders wait for confirmation, but in this case, I think the confirmation, after the confirmation, we are already very high up. And most of the times, I actually prefer to enter right after the momentum candle. When it comes to your stop loss level for your momentum candle, here it's very important to consider the market structure. So remember, here we actually have a sort of triangle pattern with consecutive higher lows. And in this case, I would actually place my stop loss below the most recent low. This is the common method for the ascending triangle, and I would actually handle this as an ascending triangle. So the stop loss level I would actually place just slightly below this point. So as always, we leave some wiggle room. And as for our target, we can either measure the length up to the entry. We take this measurement with a 2-to-1 risk to reward. Our target would be right around here. Another method is to actually measure the triangle here. So you can take this measurement, measure from the breakout, and you will also get a target something like this. So what I did right here, if it wasn't clear, is that I took this exact length, I sort of took that exact length and I measured from the breakout point. I took that measurement and our target level would have been around here. But now, a question you all might have at this point is, can't we find any other momentum candles right here? For example, isn't this right here a momentum candle? Because we can see that this candle is a very strong green candle. Well, if we look closely here at the previous candles, we can actually see that the real body of this candle right here is probably, at least half the size compared to this candle. So this isn't really a momentum candle. Once again, if we look at this candle right here, we can see that we have a strong bullish candle. The candle is clearly twice the size of this candle and this candle. But if you look at the third candle, this candle right here, we can see that the size of that candle is actually smaller. The only real momentum candle we can actually find here is this bearish candle right here. Or we actually only have 2 candles visible here, but I'm pretty sure the third candle was also less than half the size of this candle right here. So this was probably a bearish momentum candle. And we will talk more about bearish momentum candles next. Alright guys, so now it's time to take a look at the bearish momentum pattern. This right here is a very useful pattern because it appears so frequently in the market. The pattern is a simple pattern because it consists of only one candlestick. So where the pattern appears on the chart is key. The direction for this pattern is bearish and the type is continuation. Once again, this pattern can also act in some cases as a reversal pattern, but most common, this is a continuation pattern. So before the pattern appears, preferably, we want to see a move towards the downside. Then we want to see at least 3 candles with relatively small bodies. And this candle right here is the actual pattern. And when this pattern confirms, it indicates a continuation of the downtrend. So now then, how do we identify the bearish momentum pattern? Well, what we're looking out for here is that we're looking out for a strong bearish candle. And specifically, we want the body of this candle to be at least twice the size of the previous candles. I'm using 3 candles here as a rule of thumb, but it's even better if the body of the bearish candle is more than twice the size than maybe the previous 4 candles or even the previous, 5 candles. The more candles, the better, and the more candles, the stronger the bearish momentum is. We also preferably want to see the real body of the red candle be perhaps, 3 times as large or even 4 times as large as the previous candles. So now let's take a look at the bearish momentum trading strategy. And as always, the very first thing we need to do is that we need to identify the pattern. And in this case, the bearish momentum pattern can be found right here. As you guys can see, on this red candle, we have a very long real body. And the body is definitely more than twice the size compared to all of these previous candles. And remember that I said that this is most often a continuation pattern. So before the pattern, preferably we want to see a downtrend. But in this case, you can actually see that the price were in a trading range before the pattern appears. And this is also completely fine. You can actually trade the bearish momentum candle both as continuations, but also reversals. But now, what about the entry point, the stop loss and target level? Well, the most straightforward entry point is where the momentum candle closes, so enter right here. As for your stop loss, we have a few different options here. one stop loss is to place the stop just above the highest point of the momentum candle. But what we also can do is that we can look at previous market structure. So in this case, remember that we had a trading range. So we found some sort of resistance. So what we can do here is that we can actually draw a resistance zone. And one option is to actually place the stop loss all the way above the resistance. But as you can see, when we have the stop loss all the way up there, the stop will be very, very wide. So yet another option here is to actually define the low of the range. So we can define the sort of support area right here. So if you prefer a tighter stop, you can set the stop loss just above the previous support, because a common principle in trading is that when we break previous support, many times it will flip to become resistance in the future. So if we use this stop placement, we can actually allow for the price to come up and test this previous support as resistance, and we are still within a winning trade. As for your profit target, you can either, as always, you can either use a risk to reward ratio. So you take this measurement and you measure using a risk to reward ratio of 2. Your target would be right around here, right? But when we have trading ranges, we can actually also measure the range, so from high to low of the range, and then we take this measurement and measure here from the breakout. So we take the same length and our target would be right around here. All right, guys, so now it's finally time to take a look at the bull flag pattern. And this right here is one of the best candlestick patterns out there. You may wonder why. Well, this pattern appears super frequently in the market. It's a reliable pattern, and if you understand it, it's also relatively simple to trade. But first of all, this right here is a complex pattern because it consists of multiple candlesticks. The direction here, as you can hear on the name, is bullish, and the type here is continuation. So before the pattern appears, we need to see an uptrend, then the actual pattern appears, and the goal of this pattern is to continue the price towards the upside. To identify the bull flag pattern, what we're looking out for, the first candle here is a green candle. This candle can be either strong or medium size, it doesn't matter too much, and we can have wicks, both an upper wick and a lower wick. The next part of the pattern is that we want to see multiple small candles that goes in the opposite direction. So for the bull flag, we want to see multiple red candles preferably, but it can also be a mix here between red and green candles. The most important part is that the overall direction of these small candles should be either down or it can almost go sideways as well. These candles can have both upper and lower wicks, but the important part here is that we want the candles to have relatively small real bodies. The last candle of this pattern is a green candle, and we want this green candle to be at least medium size. Preferably, we want to see a strong green candle. But what we are looking out for here is that we want the green candle to close above the opening of the last candle in the pullback. So you can see the last candle open right here, so we want the green candle to close above this point. And in this case, you can see that the green candle clearly closed above that point. After this, the pattern is confirmed and it indicates continuation to the upside. So now let's take a look at the bull flag trading strategy. And as always, the first thing we need to do is to identify the pattern. So feel free to pause the video and try to do this on your own. Did you find any flag? Well, in my opinion, the most obvious flag is this movement right here. You can see that before the pattern, we had a clear uptrend. Then we saw 1, 2, 3, and 4 small candles that went in the opposite direction of the trend. And this right here was actually far from a perfect bull flag. But it's important to understand that when you are trading in real markets, you will very seldom find these sort of textbook perfect patterns. More often than not, the patterns will not be perfect, and we as traders need to be able to trade regardless. And you may wonder, why is this pattern not perfect? Well, in my opinion, the real body of this candle right here is a bit too large. Preferably, we want this candle, at least the real body of the candle, to be smaller. But this is still good enough. After the 4 candles, you can see that we do see a green candle finally emerging. And what you also can notice is that this green candle closes above this line right here. Remember, this line is created from the opening of the last red candle, and it is when this candle closes, the bull flag is confirmed. So how do we enter, how do we place our stop loss, and how do we take targets? Well, the most common entry point for the bull flag is to simply enter at the candle close of the green candle. Some traders also wait for a confirmation candle, so they wait to enter all the way up here, but many times it's enough to enter at the candle close of the green candle. As for your stop loss, the stop loss is usually set below the lowest point of the flag. So right here, we have the lowest point of the flag. So we set our stop loss below that point, we leave some wiggle room. And when it comes to the target level, here we actually have multiple options. One target option is to actually take profits already at this point, which is the high of the uptrend. In this uptrend, you can see we have a high right here, we have a high, we printed another high, and a common method is to take either partial profits, meaning that you offload some of your position at this point, or that you take full profit at this level. Another target method is to use something called a measured move objective. And what you do here is that you measure the impulsive move of the trend. So you measure from low to high, and you take that exact length and you measure from the low of the pattern. So this would give you guys a target around here. And as I said, some traders use this right here as the first target, so they take some profits at this level, and then they might take the rest of the profits all the way up here. Alright, so now it's time to take a look at the bear flag pattern. And the bear flag is a complex pattern because it consists of more than one candlestick. The direction here is bearish, and the type is continuation. So before the pattern appears, we want to see a downtrend, then we see the actual pattern, and the goal here is to continue the price towards the downside. To identify the bear flag, the first candlestick we're looking out for is a red candle. Preferably, we want to see either a strong red candle or a medium size red candle. It can have an upper wick. In this case, it doesn't. It can have a lower wick. The next part here of the pattern is that we want to identify multiple candles, 3 or more, that goes in the opposite direction of the actual trend. These candles can be either green or red, and they can also be doji candles, like we're seeing right here. This right here is a doji, this right here is a doji. But the important part here is that we want to see small real bodies of the candles, and we want the movement to be in the opposite direction. The last candle of the pattern is a relatively strong red candle, and the general rule here is that we want the red candle to close below the opening of the last candle right here. But you can see that, and this is very important, in this particular case, you can see that if the red candle closes maybe around here, you can see that the real body of the red candle would be very small. And this is something we don't want to see. We want the red candle to at least have a medium size real body. So now let's take a look at how to actually trade the bear flag. As always, we will take a look at the entry level, the stop loss, and the target. But the first thing we need to do is, of course, to find the pattern. And here on the chart, we can see that we have a very clear downtrend. We are printing both consecutive lower highs, and we're also printing consecutive lower lows. And here, the most clear bear flag is this movement right here. As you can see, before the pattern appeared, we had a strong movement towards the downside. Then we saw 1, 2, and 3 candles that went in the opposite direction. Once again, this candle, this green candle right here, preferably we want the real body of this candle to be a little bit smaller. But it's important to remember that markets are very seldom perfect. So this pattern right here is, at least in my opinion, good enough. What we can also see here is that the last candle of the pattern is a strong red candle. That is a good sign. And we can also see that the red candle clearly closes below the opening of the last green candle. As for your entry point, the most common way to enter is to enter at the candle close of the last red candle. For your stop loss, you usually want to place it above the highest point of the pattern. So this right here is the highest point of the pattern, and you want to place your stop loss just above that point. When it comes to target levels, we have multiple options. One way to set your target is to actually set it already at this point right here. But you can see in this case, when we enter right here, you can see that the distance to the profit is very, very small. So in this case, it might not make sense to use this profit target. Instead, you can use something called the 100% measure move. So you measure from the swing high to swing low before the pattern. Then you take this exact measurement, you copy the length, and perhaps your profit target would be around this point. So what's important here is that the length of this move and the length to your target should be the same size. All right, so now it's time to take a look at the bullish runaway gap pattern. And this right here is a very powerful pattern, so make sure to really pay attention. When it comes to the complexity for this pattern, it's actually pretty hard to categorize. But I'm calling this a simple pattern because the actual pattern itself doesn't really consist of candlesticks, but rather it consists of a gap. However, the direction for this pattern is bullish, and the type here is continuation. So before the pattern appears, we want to see an uptrend. Then we identify the actual pattern, and the goal of this pattern is to continue to push the price towards the upside. All right, so identifying this pattern is actually pretty simple. All we need to look out for here is a move towards the upside, and then we want to see a gap. You can see this right here, the space in between the highest point of this candle and the lowest point of this candle is considered a gap. And this type of gap where we have nothing in between the candles, you can see not even the wicks are touching, is called a true gap. So what we're looking out for when it comes to the runaway gap here is that we want to see a true gap. So for example, we don't want it to look like this. Let's say that this right here is the first candle and this right here is the second candle. You can see that in this case, we have a gap here between the real bodies of the candles. So this right here is one type of gap, but what we're looking out for here is that we want not even the wicks to touch. And this pattern is confirmed already when this candle opens. So as you guys know, for most candlestick patterns, the patterns will confirm at a candle close. But for the bullish runaway gap, the pattern confirms at the open after the gap. And that is very important to have in mind. So now let's take a look at the bullish runaway gap trading strategy. And the first thing we need to do here is of course to identify the pattern. And on this chart, the only real runaway gap that can be found is right here. You can see, if you look closely on this chart, you can see that we have multiple of these other gaps. You can see, for example, right here, we have a gap between the real bodies of the candles. And for example, right here as well, and right here, you can see that these other types of gaps, when we have a gap between the real bodies, is pretty common. But to find a gap where not even the wicks are touching is a more rare signal. Another thing that is important to notice here is that before the runaway gap, we need to see an uptrend. And in this case, we indeed saw an uptrend before the gap. Then the gap appeared, and remember, the pattern confirms when this candlestick opens. So how do we trade this pattern? Well, the most common entry point is to enter here at the open after the gap. As for your stop loss, you usually want to place the stop loss here below the lowest point of the gap. So this black line is the lowest point of the gap. And a common way to set your stop loss is to place it below this point. Why do we do this? Well, it's not super uncommon for the price to actually pull back and test the low of the gap. This right here is what we call a gap fill. And when we set the stop loss below this point, we can actually allow for a gap fill and still not get stopped out. And as for your target, you can use a simple risk to reward ratio. So you can measure this movement right here. You can take the measurement using a 2-to-1 would give a target around there. Using a 3-to-1 would give a target around there. So now let's switch the attention here and take a look at the bearish runaway gap. We can consider this pattern a simple pattern because it consists basically of 0 candlesticks. It depends on, how you define it. But I define this as a simple pattern. The direction here is bearish and the type is continuation. So to identify the pattern, we need to first see a downtrend. What we then want to identify is that we want to identify a true gap. So remember, a true gap is when we have space in between two candles where not even the wicks are touching. This pattern confirms already at the open of the candlestick after the gap. So this pattern is confirmed already at this point, and it indicates a continuation to the downside. So now then, how do we trade the bearish runaway gap? Well, the first thing we need to do is that we need to identify the gap. And if you want to, you can try to do this yourself and pause the video right now. Well guys, did you find any gap? In my opinion, the most obvious gap can be found right here. You can see we have some complete space in between these two candles, right? So here we have a bearish runaway gap. You could also maybe argue that we have a tiny gap right here. But preferably, when we see these runaway gaps, we don't really want to see very small gaps like right here. We definitely prefer to see larger gaps like in this case. As for your entry point, the most common way to enter is to enter already at the open of the first candle after the gap. For the stop loss, we usually place the stop loss just slightly above the highest point of the gap. So the highest point of the gap is right there, and we place our stop loss just above this point, and we also leave some wiggle room. So if the price goes up to retest the gap, we still have some good chances here to not get stopped out and still be within a winning trade. For your target, you can use a risk to reward ratio, so you can measure from the stop loss to the entry point. You take this measurement, and a 2-to-1 target would give us a target down here, while a 3-to-1 would give us a target all the way down here. Alright guys, so now it's time to switch the attention and take a look at a very important family of candlesticks. And I'm talking about doji and spinning top candles. So now let's spend a little bit of time talking about what these candles are and why they are so important. So first of all, doji and spinning top candles are part of a specific group that we call indecision candles. And indecision candles indicate uncertainty in the market, and they can signal potential shifts in the sentiment, and we will talk more about that very soon. And what's common about indecision candles is that these candles typically have small real bodies and long wicks. And this reflects that neither the bulls or the bears are in full control. And these type of candles can be useful in many different ways. They can be used to identify potential reversals, and they can also be used to provide warning signals. So for example, if you are in a trade, whether you are trading long or short, these doji and spinning top candles can give us warning signs that it might be time to actually exit the trade, and so on and so on. So now let's dive a little bit deeper into doji candles. And as you can see here on the screen, we have many different types of dojis. They all have different and pretty funny names. But the most important part about the doji candle is that if you take a look at the body of all the dojis here, you can see that the body is, pretty much only a line, which means that the candles open during the candle, it moves up and down, but the candle closes pretty much at the exact same level where it opened. However, it is okay for a doji candle to have a very slight real body, so it might look something like this, but we do want to see the real body either being a complete line or have a very small real body. And now let's talk a little bit about the different types of dojis, because depending on where the real body is located, the doji candles can actually be either bullish or bearish. So for the first candle, the candle right here, this is called a classic doji. And this is where the price, during the candle moves up and down, but it goes down here and closes pretty much in the middle of the candle. So the classic doji indicates indecision, or in other words, uncertainty in the market. As for the next candle, the long leg doji, we can see that the real body here has shifted a slight bit up. You can also have a long leg doji where you have the body of the candle down here, for example. But what's important to learn here is that the higher up the body is, the more bullish the candle will become, and the lower the body, the more bearish the doji candle will become. So a long leg doji can be either more bearish or more bullish depending on where you find the body. The next candle is called the dragonfly doji, and you can see that this is a case where the real body has been pushed all the way to the highest point of the candle. So let's imagine how the price moved within this candle. You can see that the price opened all the way up here. During the candle, the bears managed to push the price pretty far down, but before the close of the candle, the bulls took control once again and actually managed to push the price all the way up to the top. So this makes it so that the dragonfly doji is actually considered a bullish candle. However, as with all patterns, it's important where the candle actually appears. So this pattern, if it comes after an uptrend, it doesn't really signal too much. But if you find a dragonfly doji after a downtrend, in this case, it can actually act as a reversal candle, pretty similar to the hammer. And as you know about the hammer, it indicates a reversal to the upside. The next doji candle, the gravestone doji, is pretty much the opposite of the dragonfly. You can see in this case it opened all the way down here. The bulls managed to push the price up, but before the close of the candle, the bears took full control once again and managed to push the price down to the opening price. So this right here is a bearish reversal pattern, especially if it comes after an uptrend. The last doji candle is a very weird one. It's you can't see it right now. Let me actually move my camera so you can see the name. The last candle here is called the 4 price doji. And this one is not too important to learn because it's very rare. It's very, very rare to find these 4 price doji in the markets. But this pattern is basically when the price opens and close at the same level, and during the candle it doesn't really move at all. So this is one of these candles that definitely signal uncertainty, and often when you see a 4 price doji, they often indicate that, you know, this is something we actually don't want to trade. Alright, so now let's take a look at how we can trade using the doji candle. On this particular chart you can see that we have a downtrend because we printed consecutive lower highs and we also printed lower lows. And you can see that after this massive bearish, this was a bearish momentum candle appeared, you can actually see that we saw multiple doji candles emerging. And remember that doji candles, at least regular doji candles, signals uncertainty. So if you are in this short trade, or in other words, if you are betting against the direction of the market, and then you see these multiple doji candles appear, this can actually act as a warning signal, and that you should perhaps at least sell some of your position, or at least, you know, proceed with caution. If we take a close look at the doji candle right here, you can actually see that we had pretty much a dragonfly doji, right? So if you are in a short trade, this right here is definitely a warning sign. However, it's important to notice here that this is not enough justification for a long position and a reversal trade. It's more like a signal to proceed with caution. And as you can see, after these doji candles appeared, the price didn't reverse to the upside, but it also did not continue the downtrend. After the doji candles, we actually entered a trading range. Alright, so last but definitely not least, let's also take a look here at the spinning top candles. And the spinning top candle is very similar to the doji, but the difference here is that for the spinning top candle, we allow for larger real bodies. So you can see that all of these 4 examples are examples of spinning top candles, and here compared to the doji candle we have larger real bodies. With that said, in order to have spinning top candles, we still want the wicks here of the candles to be larger than the real body. So a good rule of thumb here is that you want the wick, both the upper and the lower wick, to be at least bigger than the real body. But now you might wonder, you know, what about if we have a spinning top candle with a very long, for example, lower wick, and, you know, a extremely short upper wick? Isn't this right here a spinning top candle? Well, you could consider this a spinning top candle, but if you look closely at this pattern, you will see that this pattern is actually pretty much a hammer instead. So when we have a spinning top candle with either a very short upper or lower wick, these patterns will actually act as, hammer patterns or, shooting stars or hanging mans, depending on where the candles appear here on the chart. But what does, all of these candles tell us about the price? Well, once again, they give us a similar meaning as the doji candle, or in other words, they indicate indecision in the market, that neither the bulls or the bears are in control. So if we see, multiple doji candles appearing, you know that we're talking about a pretty uncertain market, and that can act as a signal to either exit your trade, or depending on the context, it can actually act as potential reversals as well. All right, friends, so this long course is actually coming to an end very soon. But before we wrap up here, I just want to thank you all so much for watching. If you guys did enjoy this course, please don't hesitate to drop a like on the video. That really helps out more than you think. And I'm super thankful for all the support. And also, of course, if you have any questions or feedback about this course, feel free to leave a comment down below. You can also drop a comment down below and tell me what do you guys want to see in future videos here on the channel. And last but definitely not least, when you are ready to take the next step on your trading journey, I highly recommend that you check out this playlist next. This playlist contains all the educational trading courses I have made so far on the channel, and more videos are coming very soon. So yeah guys, I hope you all will have an amazing day, and I hope I will see you guys in another video very soon. But for now guys, take care, ciao ciao.